I'd like to turn to financial inclusion, which is a huge part of how much tech is changing payments. And Samir, let's start with you. Obviously, giving loans to small and medium businesses, you see a need there in the market that is being underserved. How important is that, and are you finding that financial inclusion is something that's motivating new customers to come to you? Are they finding you that way?
Yeah, I mean, definitely. I mean, we focus mainly on prime small business borrowers, so about 80% or so of the borrowers that take a loan through us would be able to get one from a bank. But we are expanding the market, and I think what's very interesting about this stuff is, you know, clearly you're not allowed to use stuff like ethnic data, gender data, things like that in your models, but you can infer from where the banking system is underserving certain groups and populations. And we see it, and you know, because we're in multiple countries as well, we can see different countries have different degrees of financial exclusion almost for certain parts of the population, not necessarily based on risk, actually, as far as we can see. So I think, you know, this kind of idea of, you know, moving stuff away from sit in front of a branch manager, get assessed that way to almost an anonymous way of doing things will increase financial inclusion just by the nature of the way it works. But some of the stuff we've seen is slightly scary in terms of how excluded certain groups are.
Yeah, I think there's huge opportunity that you look and see, you know, you've got billions of people in the world that still don't have access to basic financial services. And then when you think about the opportunities afforded by the digital economy, which, you know, have been tremendous for some, but certainly it's not yet evenly distributed. And if basic financial services are a prerequisite to really participating in the digital economy, getting broad access to basic financial services becomes quite important. At the same time, I think there's another thing happening, which is just as we're all still really starting to grapple with this problem of how do you get basic financial services in the hands of everyone, that's far from a solved problem. There's a new problem starting to emerge, which is what it means to be underserved, I think, is shifting dramatically. So, you know, you look at, you know, job creation, and for example, 90% of the job creation in the US over the last 10 years came from alternative work, which is gig economy, freelancing, these types of things. These are folks that don't get a steady paycheck every week. You know, they have variable income. The entire financial infrastructure has really been built to cater to a predictable, steady income of somebody's gonna go work for a firm and work for that firm for many, many years. That firm will help connect them into how they plan for retirement, you know, how they get a steady income stream into a consistent checking account. And then if you think, wow, a huge portion of the workforce now isn't getting that steady paycheck every week, doesn't have an employer to guide them to how to save for retirement, you now have, you know, an entire segment of the workforce that needs to consume financial services in an entirely different way. And that problem, I think, is one that has sort of snuck up on everybody because it's, as I said, 90% of the jobs created in the US over the last 10 years, that's not a potential problem to be addressed over the coming years. It's here right now. And so I think there's a lot of opportunity to really address that group of the financially underserved, which I think is still not really well understood.
I think Bill's spot on. This is a topic I'm really passionate about. That I think it's a double problem. So there's the gig economy jobs, and it's not just access to lending, access to payments. It's also insurance. Because also if they're in business and they're working for themselves, they need to get insurance. And if they've got variable income, access to insurance can sometimes be even tougher than access to the loans. But then also combine that with shared housing. Because historically, a bank likes to lend against a collateral, the house. And again, there's a whole bunch of millennials who are just sharing and renting because the house price is so expensive. So you've got a double problem that the typical, tape measure for a financial system just doesn't work. It's like we're moving from inches to centimetres and we don't have the tools. So I think we need, so number one, part of the answer is data. So I think actually the public sector, working private sector, need to think about how can we make sure we get thicker credit files, you know, the right data so people can make those loans. And I think through a richer data set, you probably do need to combine it with digital ID of some sort, and actually thinking about the problem from back to front. What does the customer need, and therefore what infrastructure we need, I think is actually going to be a huge area for focus for the next couple of years.
And how do you broker trust, right?
Completely.
Like you get, you know, the data really is sort of a pathway to how do you broker trust? How How do you know you can lend to a person, with confidence, even if they don't have the sort of traditional definition of a steady paying job, or they have a living, situation which is not the traditional definition of a person buys a home? How do you broker that trust? I think that's going to be quite important as well.
I think it's very interesting. Another example of this is we've been working with Unilever in Africa, and we've been saying, look, there's a lot of little shops there that actually wait until their shelves are empty to be able to order again because they need the cash to actually pay. But the fact is they're part of Unilever's supply chain. So is there some way we can capture that data, create a payment flow that gives empirical evidence about how their business is working and allow them to get credit from someone in the economy, usually a bank, so that they can order more washing powder before the shelves, are empty. And actually, we've done this across quite a few thousand little shops in Kenya. Many of these are operated by women, by the way. It's proved fantastically successful. I mean, they got an uplift of something like 20% in the first few months of sales. It's great for them. It's great for the lender. It's great for us because we put the payment flow in. It's great for Unilever. Yeah. So you can see these big supply chains could be interesting. The other thing we've done on the gig economy, we realized that, say, Uber or Lyft or Grab or these drivers don't want to sort of wait until the end of the day or the end of the week to be paid. So we started to give them cards that could actually, they could be paid per journey. It could be downloaded for them whenever they specified, which actually allows them to manage their cash much more easily. And on the housing side, of course, we've seen the rise of Airbnb, which is very interesting. And the whole electronic payment space has allowed people to go into these businesses of being able to rent their houses and become like the biggest hotel chain in the world because the infrastructure was there to do it and the data's there and so on. So it's a very interesting time, a very shifting needs and businesses and how people are living. But inclusion is super important.
This point of funds velocity, I think, is something that is playing out right now, which is, for those that are participating in freelancing, gig economy, these types of jobs, alternative work, they're oftentimes working in multiple different places, which means there can oftentimes be multiple intermediaries between them and getting their funds, which means funds are held up or delayed. And I think that if you're trying to think about this issue of, how do you solve for the lack of a steady income? How do you solve for bridges between periods of income? The fact that a lot of funds are held up with multiple intermediaries already is a meaningful issue. And it's actually something we looked at and said, well, actually, in some ways, we were contributing to that and have moved to, we call it our Funds Now initiative, which is saying instead of having, the typical wait time and payments of if you're a small business, you wait, 7 days to, 3 weeks, how do we get to immediate access to payments, exactly as you were talking about, and doing that with some of our partners. But, there's all this innovation in the world of payments, but in a lot of ways, even as the technology has gotten faster, the money has moved slower. You think about a small business that moves to digital acceptance. That small business used to accept cash. Somebody would hand them cash. They could spend that right away. And you had new technology come in, and then somebody would give them a card or pay them in a digital way, but then a payment provider would have their period of time they're holding the money, then there might be time waiting for it to be moved to deposit. And so the technology was better, but the money moved more slowly, getting to now a place where you say, oh no, if a customer pays you now digitally, you have access to that right away, I think is fundamentally important and helps with a lot of these issues.